Yeah, so getting ready for the Fed this evening, European Central Bank, if you're seeing the recording, this will be recorded, Bank of England and non-farm payrolls down the road. So my name is Yochai Elam. I used to be a retail trader and a computer programmer. I founded my website Forex Crunch in 2008, joined FX Rate 2018. Yeah, it's been 5 years, we're already in 2023. I focus on fundamental analysis, that's what we'll talk about now. I'm leading FX Rate's premium product, premium offering. And yeah, before we dive into all these events, I want to invite you, if you're still not a member of our premium service, so you get to tap into more than 20 years of Forex trading experience. We provide trading alerts, trade plans, notifications, alerts, and as some of you, I know you guys from who are already members, you can just tap into our knowledge by asking any question, and we have a really great community. So it's not just traders helping each other, which also works very well, but also people like here, but also ourselves, the analysts, answer your questions. Okay, we provide trading plans where you can leverage our knowledge, and we get lots of positive feedback. What I need to know when I know it. When I need to know it, excellent insights. You really inspire me. We have lots of great testimonials right here. So yeah, you get to follow our trade plans. You get all the premium and exclusive analysis. And yeah, and just for today, we have an offer. 50% off our annual plan. So basically you pay only for 6 months and you get another 6 for free. So let me share the link. Yeah, so you can use this link to sign up. Yeah, it's quite a treat. Okay, so I encourage you to sign up to premium if you're still not there. I'll remind you also later on. Yeah, I have to do this quick pitch, but yeah, you came here not for well, only yeah, I have a 2-year subscription. Good indeed. Yeah, thank you very much for the positive feedback. Good, it's genuine. It's so yeah. So let's you're welcome to sign up. Use that link, 50% off. And yeah, let's kick it off. Let's talk about the Fed. The Fed is coming up in, well, under 3 hours. So this will probably not be useful if you're watching the recording, but maybe you'll get to see if I'm right or I'm wrong. So let's stop. Well, let's start with the first things first. Fed is going to raise rates by 25 basis points. If you're watching the recording, I don't think I'll be wrong on this one, okay? The Federal Reserve does not like surprising markets. Bond markets priced a 25 basis point rate hike. Fed officials embraced it by not pushing back. That's it. No 0, no 50 basis points. Last time it was 50, before and 75. Fed is slowing down. Okay, the statement will mostly be, the Fed publishes at 7 p.m. GMT, that's 2 p.m. Eastern time, statement announcing the rate hike in this case, and other comments about the economy. It will mostly be copy-paste. Don't expect the huge things from that, but the highlights that we can see is that inflation is coming down. Good, we already know that, and the labor market remains strong. Just this afternoon, we received another figure, the JOLTS job openings, that showed a jump in the number of openings. So there are more than 2 open positions for every 1 unemployed person looking for a job. Okay, that's 3.5% the U.S. unemployment rate. So the Fed will say more hikes are needed. Okay, that'll be a bit of a copy-paste. No signal of a pause. Nothing like the Bank of Canada did. So yeah, let's begin talking about the details and what I expect Powell to say, what I expect him to say. So we're talking about that higher rates are already having a good impact on inflation. Inflation is coming down. Housing prices are falling. It's becoming colder out there, yeah? Okay? Another positive thing is happening to goods prices like Pelotons or cookware. People are buying less stuff and there are fewer supply chain issues. So inflation when it comes to physical stuff is coming down. Oil, it's come down due to multiple factors. The US released oil from reserves. Russia is still exporting oil to China. Iran is exporting to China. Less demand from China late last year because of COVID restrictions. We'll not dive into that, but that's okay. Before we talk about the problematic parts of inflation, core inflation is also coming down. So it's not only the price at the pump. We're also seeing prices excluding food and energy also falling down. Okay, so yeah, and not everything is great. So we heard lots of tech companies announcing layoffs. Now, I'm not worried about very highly talented, highly paid programmers losing their jobs. They'll find another job. They probably already have found one, but this is becoming massive. This is becoming hundreds of thousands of people. And it has impact on other industries as well. Okay, people working close to tech offices, for example, in restaurants or whatever. Another worrying figure is that Americans didn't buy that much for Christmas. So we had weak retail sales around Christmas. Even wages, according to the non-farm payrolls we had last month for December, they are cooling down. So the pace of salary hikes is falling. So but that was only one-off. Yeah, and yeah. So I prepared this slide, this chart, before the latest data that came just an hour ago. Jobs are off the highs. Well, they're not off the highs anymore. They're still very high. That means that there are many job openings for every vacancy. So it's a mix. I expect, because of this jobs figure, but not only because of that, from Fed Chair Jerome Powell, the person here in the picture, to be very hawkish, to push back against what markets are expecting. What are markets expecting? Markets are expecting another rate hike in March, and then a pause for another month or two, three, and then for the Fed to begin cutting interest rates this year in 2023. I think the main message from the Fed this evening will be no rate cuts. He probably will not say read my lips or something like that, but the message will be we're going to keep interest rates very high. Okay? Why? The Fed fears that premature easing. So history shows us that when central banks cut interest rates too soon, they declare victory on inflation. Yeah, we've killed it. You don't want to hurt the economy too much. Inflation comes back. It's ugly. Okay? And they are focusing on that sticky part of inflation. The ones we have lots of job openings. We have wages, which are again mixed. So the Fed calls it non-shelter core services. Very long, but basically it's, well, non-shelter. Shelter is housing. So put housing aside, it's falling. The Fed ignores it. Prices of goods, they're falling, ignore it. And of course, non-core is oil prices don't. So the Fed is focusing on the only part of inflation that is rising, but for a good reason. And the reason is that it's related to the rise in wages. It's the stickier part. If you work for a company, your employer is not going to cut your salary. At least I hope so. If you buy a product in a store, you might get a discount. That's something else. Okay? And yesterday we had sorry, a figure called ECI, that's the Employment Cost Index. It's related to wages. It eased a bit from 1.2 to 1% quarter on quarter, but it still remained above pre-pandemic levels, which are around 0.7%. So yeah, I have a question here. I'll answer it quickly. Isn't the market expecting cuts for the second half? Yes, exactly. The markets are expecting cuts for the second half, and I expect Powell to say no cuts. We're going to leave rates high. Markets will not want to hear that. Will they believe him? That's something else. It depends on the data. But I think they will not believe, they will still be shocked from the message, or at least respond to it in a negative way. So I expect Powell to hit markets with this message. Again, I repeated it here, the same line, no cuts in 2023. And that one thing he might say is that they'll get new forecasts in March. Remember, the Fed has 8 meetings every year. Every other meeting, they publish new forecasts, what's called also dot plot. Not this time. We had one in December. The next one is in March. So let's wait for more data. Another thing here is that Powell is unhappy with the market rally. He probably thinks, the Fed thinks, that this party in markets, these expectations of rate cuts in 2023 are premature. So yeah, he'll probably say something like the December dot plot. What we told you last time, that interest rates are going to stay above 5%, 5.13, 5.25 in 2023. We're sticking to that, and markets will not like that. So here's sort of a graph showing the dot plot. Most members see interest rates stabilizing at around 5.25. And Powell will not say what the next forecast will show in March, but he'll say that, as far as we know, no changes. And the markets are not going to like that. So, market reaction. I expect stocks to fall. They've been rising in January very nicely. So it's time for a correction. And yeah, well, I got this slide wrong. Sorry, stocks to fall and the dollar to go up. I think hopes for the Fed are too high, especially after today's weak ADP figure, especially after yesterday's ECI, and in general, markets are too optimistic for the Fed. Maybe they're right, but not this. But for now, I think the Fed will shock markets. So I think they will eventually be right, but everything is data dependent. We have non-farm payrolls on Friday, CPI in 2 weeks, and until the March decision, we have another non-farm payrolls report and another CPI. Okay. So another quick question here: will we see new lows in the dollar? No, I expect. Sorry, I expect the dollar to go up today. I mean, I expect new lows in the dollar later on down the line in a few days or a few weeks. But today I expect positive reaction for the dollar, negative for stocks. I expect the hawkish Federal Reserve. Okay. The broad trend in the dollar is to the downside. Since October, November, it peaked. Because the Fed began talking about slowing the pace of rate hikes because inflation came out very low. I mean, in the October report that came out in November, the December, the one that came out for November and December, and the last one came out 2-3 weeks ago for December, they all showed weaker inflation. But for the Fed, it's too early to declare victory because wages are still rising, and wages impact and wages are sticky. They do not fall fast. Okay, so if you go to your hairdresser, I don't need a hairdresser, but you probably need. Then the hairdresser gets a salary. The employer will not lower the hairdresser's salary so fast because there's enough demand and it's very painful to lower salary. So and that hairdresser still has lots of money in their pockets, and they're going to buy more stuff and keep inflation higher. That's the logic of the Fed. Not only hairdressers, it's also accountants. It's anything that is services sector and related to wages. Okay, so that's the Fed. That's the main event, but only one, and things become busier tomorrow. Tomorrow we have the Bank of England and the ECB almost at the same time. Bank of England is 1 hour, 15 minutes before, but I'll start with the ECB because it's more important. European Central Bank based in Frankfurt. And it's going to out-hawk the Fed. It's going to be even more hawkish. First of all, the rate hike is going to be 50 basis points. Because that's what they hinted. They said, President Christine Lagarde said last time that they're going to raise rates by 50 basis points for multiple times. Okay, we're going to stick to that at least one more time. No change to the planned quantitative tightening program. Quantitative tightening means withdrawing money out of markets. So the ECB was buying bonds, then they stopped, just kept their balance sheet stable. And they announced that in March, they're going to reduce money out of markets. That's the opposite of printing euros, okay? So they're going to say no change in the plan. The question is for markets, as always, not policy announcement for now, but hints about what's next. Markets are always forward-looking. So everything looks good for the lucky old continent. Here are the leaders of France and Germany. On the right, Emmanuel Macron. On the left, Olaf Scholz. Yeah, inflation has come down. Headline inflation to 8.5%. This is data we got today. It doesn't include German data. Yes, I know, but still going in the right direction. On the other hand, core CPI, again, core CPI related to wages, is stubborn. Here in the old continent, unions are much stronger than in America or in the UK. So we have collective bargaining. That means wages, again, it's harder to lower them. Okay, and this is the kind of inflation the ECB can fight. It cannot fight energy prices because they're coming from abroad. Can't fight food prices. Well, some come from abroad. but it can fight inflation related to wages. So yeah, if core inflation now is at 5.2% and governments are still using a lot of their firepower, then the ECB's job is to counter that by raising interest rates and lowering inflation. So since the pandemic, governments in the Eurozone, now it's 20 countries already, they've been spending more money. And it's become harder to spend money when interest rates are higher. So we saw a leap in the pandemic somewhat into 2020, then an easing in 2021. And these are incomplete figures for 2022, still very high debt to GDP ratio. So governments have been spending a lot of money, and the ECB is going to counter that. So again, the reaction depends not on what's coming out tomorrow. I mean, the news we know almost for sure, but what the ECB says about the next move. I expect President Christine Lagarde to signal very strongly, not a promise, but well, to give us a big hint, that they're going to raise rates by another 50 basis points in March. That'll be positive for the euro because markets are not fully pricing in another 50 basis point hike. Why do I expect this? Because hawks are in control. The Germans have been warning for years about inflation. It was usually the boy that cried wolf. I mean, they've been warning about inflation since the depth of the Eurozone crisis some 10 years ago. But yeah, finally the wolf has come. Inflation is rising, and they seem to be vindicated. They have a majority now in the ECB's governing council. I expect the euro to rise, but majority is not unanimity. Okay, so we have ECB doves and hawks, and what happens usually with the ECB, from my experience in recent months, is we get a decision that is hawkish, and then the doves come out. We get a decision that is dovish, and then the hawks come out. So I expect something like an hour or two after the decision. I expect the doves to try to take revenge, to show that they do not agree with the hawkish message, that they are worried that growth is only 0.1%, and that the war is taking its toll and things like that. I'm going to talk to Reuters probably, or who knows who, and we're going to see headlines. ECB sources say there many wanted to raise rates by 25 basis points in February and support a 25 basis point rate hike, or open to not even raising rates in March. And I think such ECB sources headlines, that I cannot guarantee that they will come, but it usually happens, they can come out and hurt the euro. Okay. A bit more, the ECB, what we saw in recent months, is that it has more impacts than only the euro. Okay, the ECB's Eurozone is the second largest economy alongside China. If you look at all the Eurozone as one area, not all at individual countries. And if we get a very hawkish ECB, it's bad news for markets. When things go bad in markets, it's good for the dollar as a safe haven. Okay, so we might see the euro rising, but also the dollar rising, not against the euro in response to the ECB, but against other currencies, and stocks potentially suffering. This sources report that may or may not come, but let's say it comes, will push the euro back down, but I'm not sure it'll help markets because markets might still be hit from the Fed and the ECB. Again, these are my projections, not something that can be guaranteed, but I expect a hawkish Fed, a hawkish ECB. That's not going to be very good for stocks. And even if ECB sources say that there was some dovish disagreement, I don't think it'll help stocks that much. Okay, now we have the Bank of England. So, we have a hawk sandwich there. Yeah, 50 basis point hike expected because inflation is still high in the Eurozone. In the UK. But this is going to be a dovish hike. The tone is different. First of all, the Bank of England also releases its meeting minutes. We have 9 members in the Bank of England's Monetary Policy Committee, MPC. And they have very different opinions. not afraid to share them. They're not aligned with the governor. Some are more hawkish, some are more dovish. Last time we saw one member, I think Catherine Mann, she voted against raising rates at all. Okay, so I think we'll see a strong minority, 3 or maybe even 4 out of 9 members supporting only 25 basis points or no hike at all. And that sort of undermines the hawkish tone. I mean, you raise rates by 50 basis points, but with a big majority against it, that means it's not that strong. What's going on also in the UK? So, well, this is Andrew Bailey, the governor of the Bank of England. Sure, he smiles from time to time, but usually he's gloomy. I think they're a bit ahead of the curve in forecasting reality that all these rate hikes, all this inflation, it's going to take its toll on the economy, but also for good reasons in the UK. We had IMF forecasts, International Monetary Fund said the UK economy is going to shrink this year. We have a cost of living crisis, which is biting. We have biting in the sense that people are on strike. About 500,000 Brits did not work today. A series of coordinated strikes, and this guy, Andrew Bailey, is usually downbeat. Okay, so it's Super Thursday, what the Bank of England calls Super Thursday. Not going to be very super. We have the monetary policy report. That's what makes this Thursday super. Like the Fed, the Bank of England publishes these quarterly reports only once every quarter, once every other meeting. And it's this time. The Fed doesn't publish new forecasts this time. The Bank of England does. They're going to be downbeat, talking about a recession, talking about issues in the economy. And even if we don't talk about forecasts, the UK economy, among all developed ones, is the only one that has not returned to pre-pandemic levels. It's Brexit, it's other reasons. That's just reality. Okay, so we might see inflation forecasts falling because, well, energy prices are falling. But that, I think, will only hurt the pound even more. And once again, the Bank of England will be sandwiched between the Fed this evening and an hour later, a hawkish ECB. So I think the pound will be quite a loser. Okay, we talked about these 3 central banks. Let's move on to non-farm payrolls. Seems like the easiest event, but it's always a top-tier event. Well, we have so many critical figures this week. So, current forecasts on our economic calendar show an expected increase of 190,000 jobs. That's roughly pre-pandemic levels, back to normal. We had much higher job gains in the past, so this is very, very normal. Goes in line with the broad slowdown in the economy, so far of a soft landing. Yeah, but we have mixed incoming data leading figures. So we had jobless claims under 200,000, which is very, very good news. Okay, low unemployment benefits. But ADP this afternoon was very weak, only 106,000 jobs gained. It was due to weather issues, so it also paints sort of a mixed picture. And we also had the ISM manufacturing PMI, which showed growth in hiring, just about 50 points there, but it's quite mixed. Okay, so I think expectations are more or less realistic, 190,000. Broad surprises are common with the non-farm payrolls. This is what I expect. If we have 200,000 or higher, so within expectations or better, it's positive for the dollar because, well, the economy is doing well, labor market is doing well, more rate hikes are needed, stronger dollar. If we get between 100 and 200,000, that's a weakening economy, fewer jobs gained, and no need to raise rates very fast. But if we get very bad data, under 100,000 or even worse, even negative number, yeah, especially a negative number, then we might see the dollar rising. Why? Why do I see this? Don't know how many of you are familiar with the dollar smile theory? Well, the dollar gains ground in the extremes. When the US economy is very strong, we need rate hikes, dollar up. Very simple. On the other extreme, when the US economy is doing very badly, then all the world is doing even worse. So why not jump to the dollar, the ultimate safe haven? Good. So because when the U.S. sneezes, the world catches a cold. In the middle, when we have a mediocre U.S. economy or growing but not overheating, then we have money flowing outside the United States to other areas to take risk. So yeah, I think it'll be somewhere as expected, around 200,000. I don't think it'll be very special. But I think what will steal the show is wages. Again, Federal Reserve this evening, assuming it'll do at least one part of what I expect it to do, focus on inflation related to wages. That'll make the wages part of non-farm payrolls officially called average hourly earnings, salaries, monthly pay, whatever you want to call it, the money we get from our employers. They'll expect it to be of higher importance. So our calendar is showing an increase of 0.3% in line with last month. That makes sense to me. I have no idea if it'll be higher or lower, but 0.3 is still a bit above 0.3 month over month is 3.6 or nearly 4% annualized. So it's relatively high. We could see it fall a bit more. Last time it fell more than expected. So I think if it drops to, if it just rises by 0.2, we could get the dollar falling. Year over year, here it was 4.6% last time, and now we expect 4.9. I think it's a bit too high. That's where we could have a negative surprise, which would be bad for the US dollar. So that's where we could see I think weakness for the dollar in the non-farm payrolls, and that could be a trigger for reversing gains related to the Fed. Again, I'm assuming the Fed will be hawkish. We don't know that yet. Nothing is guaranteed. So that concludes what I prepared for you. Here are my bets. What I expect to see. This is not trading advice. I expect this evening the Fed to be hawkish, to reject market expectations of rate cuts in 2023. That should boost the dollar, but we'll probably get whipsaws. Why? Because it always happens. We get markets moving in one direction in response to the statement, then the other direction when Powell talks. It'll be probably dollar favor, and then we usually get another reaction in Tokyo, another one in Europe. We need to follow analysts. I'll mention Nick Timiraos of the Wall Street Journal. He's very close to the Fed. He knows what's going on. Well, he gave us that hint back in June that the Fed would be raising rates by 75 basis points. So he's been relatively hawkish. So it's another reason to expect a hawkish move. But his analysis post-Fed is also one of the factors to watch. That's today, Wednesday. Tomorrow, Thursday, I expect the ECB to be hawkish, at least at first, raising rates by 50 basis points and hinting of another such move in March. But then the ECB sources could come out and say, well, not all of us agree to that. We'll see. We don't know. It depends. And that could take some of the hot air out of the euro. I'm less ambiguous about the Bank of England. It's usually negative. I expect it to hit the pound with some gloominess about the UK economy, about strikes, Brexit, you name it. And on Friday, my expectation is to see headline non-farm payrolls to come out more or less within expectations, and wages to steal the show with a small miss, 0.2 month over month, 4.7, let's say, year over year, something that is not that strong, and that could hurt the US dollar. Again, these are my forecasts. They could be right, they could be wrong. They'll probably be partially right and partially wrong. So yeah, just the idea here is to give you some food for the thought. Okay, that's what I've prepared for you all today. Let's see if we have more questions. Yeah, sound is glitching. Well, I hope can everybody hear me? It's okay now. Okay, sorry for the technical issue. Try to use the best conditions and the best microphone. My end is fine, no problem. Okay, I'm glad that it didn't happen to many of you. Yeah, technical advice if you're trading or anyway, you need a fast connection. Connect your computer directly to the cable. Use old tech rather than Wi-Fi. Yeah, and yeah, if you have any questions, everything clear. Okay, good. Well, I like getting questions and answering them, but if you don't have any questions and it's because everything is clear, then I probably did a good job in explaining my thoughts. Yeah, thank you. Very good session. Yeah, let's see what's going to happen. I'll share with you once again. Remember, we have the premium offer. It's, yeah, take advantage, 6 months off. Special effects here on the presentation. Anyway, you get to tap into our knowledge. Pay for 6 months, get 6 months for free. We have lots of really positive testimonials. We're growing fast. Traders like yourselves who are not on premium, traders like yourself are already on premium, and it's a good idea to join. Yes, the Federal Reserve, sure, it affects US 30, US 30. For those who don't know, this refers to the Dow Jones futures. So yes, I expect the Federal Reserve to have a negative impact on stocks, including the Dow Jones, have a worse impact on the NASDAQ, on tech stocks. They're more sensitive to stocks because tech stocks price in very high growth, and you can't have very high growth if interest rates are high. But yeah, but the Dow Jones, I also expect it to suffer and then only to recover on Friday, to have meaningful recovery. Again, these are my forecasts. In any case, I focus on the dollar or FX rates, but everything that I said about the dollar, it's just a mirror image on stocks. So, well, I did mention stocks actually. So, yeah. So next direction of the dollar after all this, the broad trend in the dollar is down. The Federal Reserve is we already had peak hawkishness. We already had peak inflation. They're going to say that the low-hanging fruits they got them, but now inflation will still be stubborn until it comes down. Markets don't believe that. I agree with markets. I think inflation will continue falling relatively fast. But today they'll push back against that, and markets listen to the Fed. So I think the Fed is going to, the Fed is going to have a negative impact on markets, a positive impact on stocks until we get new data, new meaningful data, non-farm payrolls, CPI. These are the top figures, CPI more than non-farm payrolls. And then we're going to have more data such as retail sales, the services PMI, which comes after non-farm payrolls. We have also the jobs report, PPI, the producer prices. Markets have become much more sensitive to data. But again, there's CPI, which moves currencies hundreds of pips, and then non-farm payrolls, which is, well, very volatile, and then all the rest. But look, we had relatively strong impact today from ADP. It boosted stocks because it was weak, even though ADP said that it was impacted by weather. It was all because of weather in the Midwest, and they saw strong job growth everywhere except the Midwest. So markets do what markets do, react first, ask questions later. So yeah, another question here. Do you expect recession happening sometimes? I think that if the Fed really sticks to what they say, to what it says, if the Fed doesn't cut rates, then we're going to have a recession. But there's still a chance of a soft landing. So what I think will happen is we'll get some job losses in February, seeing it in March, or a weak CPI, or a mix of both, and then we'll get the Fed beginning to talk about pausing either in March, or in March raising rates and signaling a pause, and then markets will smell rate cuts, and the Fed will say, okay, you know what, we changed our mind. Because the data changed, we have to change our mind. Remember in 2021, December 2021, that was only a year ago, the Fed forecast that rates would end 2022 at 0.9. What happened 5 times that rate? 4.5%. So the Fed's forecasts for a year ahead, take them with a grain of salt. Even the Fed says these are our forecasts and we can change them. We're data dependent. We're taking decisions on a meeting by meeting basis. So that's it. Don't you think indexes like you said currently overpriced? Yeah, well, there's especially Nasdaq is overpriced and there's room to fall. I think the Fed will trigger a fall, but stocks will gradually rise. Not all stocks are overpriced. Tech stocks suffered quite a lot. Maybe they still have a way to go, but if the economy continues growing, company earnings will continue growing, and that will make well, overpriced is a matter of perception as well. So yeah, maybe overpriced in comparison to the past, but doesn't mean they'll fall if the prospects are for falling interest rates. Hope I answered that question. Yeah, let me share again the link to our special offer for premium. Join people like you. Another question here. What about dollar yen? When should it reach 118 level? That depends a bit more on the on the Bank of Japan. So the Bank of Japan is currently led by Haruhiko Kuroda. In the past almost 10 years, he finishes his tenure, second term, in April. We do not know who his successor will be, but there will probably be a change. Kuroda has been extremely dovish. The Bank of Japan's policy now of buying bonds, printing and to buy bonds, 10-year bonds especially, it's unsustainable. They hold most of the bonds of the Japanese government. They will just run out of bonds to buy. So, and inflation is also rising in Japan. Okay, everything is reaching Japan a bit later than the United States, for example. But I expect from April, I expect the Bank of Japan to signal raising rates from minus 0.10 to 0, for example, or a bit more, and ending its program, or at least lifting the cap on 10-year yields. It's extremely dovish and it's unsustainable. So I expect a change coming in Japan, and that will be the bigger move for dollar yen. But yeah, if we get weak data in the US, again, not horrible data, not a catastrophe, because that would trigger safe haven flows. But if we get weaker job figures, weaker inflation, markets will think, okay, we're right, the Fed is wrong, time to push forward, even bigger rate hikes, expecting bigger rate hikes, and the Fed will eventually accept it, and that could push interest rates, the dollar down, and maybe not until 118, but kick the dollar down. Again, I don't expect to see that today. We're currently around 130. Maybe we'll get a small boost to the upside today. Yeah, thank you everybody for coming. Time is it? I have to get ready for a live coverage of the Fed in the premium section and Discord channel. We'll be covering the events and also covering the events and answering your questions, of course. I think that's our added value in the premium section. You can just ask us anything. Okay, I see no more questions, and yeah, well, time passes quickly. Hope you learned something new, got food for the thought, enjoyed the session. Yeah, gold moves with stocks in general, moves with 10-year yields. So if I'm right and we have a hawkish Fed, we'll see gold falling this evening. If I'm right, and we'll see a dovish, a weak non-farm payrolls, we'll see gold rising. In general, gold is trending higher, but in the past month or so, it has consolidated. So lots of movement in gold. I know many of you, of our premium members, are interested. We're answering lots of questions about gold, and there's lively discussions in our community also about gold, as far as I've been told. So yeah, lots of price action over there. Yeah, it's been moving in a range, and now I expect the range to break. I expect it to break to the downside this evening and then to climb back up But yeah, these are my my thoughts, of course, not trading advice. Okay, so yeah, our time has run out. So this webinar will be available tomorrow. Yeah, and I wish you all successful trading. Trade safely. Don't use too much leverage. These events can go wild. If you're not a premium member just yet, please sign up. I'm waiting for you over there, and so are my colleagues. And yeah, that's it for today. Thank you, and see you, and good luck. Bye bye.